Hey friends, this is Ayan here and Hey friends, this is Ayan here and a warm welcome back to you on YouTube channel, the Delta Neutral. Okay, so if you are new to my channel, please view my channel. I am repeatedly going on publishing some posts on some good derivative strategies and good habits in derivative trading, which you need to adapt in order to get out from the market with profits. Okay, we all know that derivative trading is quite risky, so I always prefer high probability trading. In fact, I myself also faced huge amount of losses at the initial point of my trading career, and right now I understand that what are the good aspects of high probability trading. Okay, how we should select strikes, how we should select instruments in derivative trading. It's completely different from that of the equity market. Okay, so there are several strategies involved, there are several other instruments involved, there are several other payoffs involved and all that. Okay, so in this video my motto is to very simply make you understand that what can be a good answer for the much debated topic, option buying versus option selling. Well, I know that some of you, yet most of you watching this video might be experienced traders, might be pro traders, and they might be thinking, well, this is a very common topic, we don't need to hear upon this. But I just for especially for beginners, I just want to give you a little truth table, okay, or a little chart which will help you to take decisions which will steer your judgments at any point of time whenever you are trading with derivative contracts. Okay, it is going to be pretty simple because I am not going to make this topic a clumsy one, because in several discussions in several books I have read that there are several viewpoints on option buying and option selling. And yes, most of the experienced traders, or most of the professional traders, or in most of the, in most of the places in internet, you'll get that option selling is always a more profitable business than that of option buying. Okay, and even some people are so strongly biased toward option selling that they always call themselves to be net option sellers or to be clean option sellers, but the neighbor prefer buying options, and that is due to theta decay. Okay, so we will discuss, we will jot down all these points, and we will discuss in short what to do when. Okay, so it's not always true that the option seller is going to be the winner, because we all know that we all said that 90% of the people who are making money in the market, they are option sellers. Then who are buying the options? Okay, if there were only option sellers, there could have been an imbalance. Okay, in the derivative trading segment, we also see options of 10 rupees or 20 rupees touching 100 rupees. At the same time, we see options at 100 rupees touching 10 rupees. Okay, it's not only true that option value always decreases due to theta decay. There are several other parameters which can even multiply an options value to 10 times or 20 times or 8 times or whatever. Okay, so it's not at all true that the option seller will always make profit. It's your viewpoint, which if goes correct with the market, you will be in profit, and if goes wrong with the market, either you need to adjust or you need to accept your losses. Okay, so first, let's have a look how the volatility surface charts look like. Okay, so in order to show you the volatility surface chart, I am using the one provided by Opstra. So right here on my screen, you can see that I have opened the Nifty implied volatility surface, and you can see that. Let me zoom it a little bit. Okay, so you can see, so these are the strike prices. Okay, so in this way it is increasing. It's 18,000, 17,950, 17,600, all that. So slowly towards the downside of the market. Okay, slowly towards the downside of the market, you can see that the implied volatility, okay, the implied volatility is slowly increasing towards this side. Okay, it is slowly increasing towards this side. Okay, and another thing you can just see here is this is the expiry. Okay, so this is the, these are the expiries. This is the 16th December expiry, this is the 2nd December expiry, and this is the 9th December expiry. So these are the different expiries. So more we are approaching towards the near expiries, more the implied volatility is increasing. Okay, so what are our observations from here? Our observations are that the implied volatility of an option, okay, it has a higher impact in the near expiry options. See, in the lower expiry options, the implied volatility is usually less. Okay, But in the near expiry options, in fact, even little spikes of 50 or 80 point spikes in the market can cause a drastic increase in or a drastic change in the prices of the options. Okay, in case of near expiries. But as far as the expiry date goes, the impact minimizes the impact of little spikes in prices like 50 points, 100 point spikes in the market. They generally don't impact that much on the far expiry options. Okay, so this is our first observation. And the second observation is, here is the volatility skew. Okay, here is a volatility skew. What does this infer? See, this is just like a floating piece of paper, okay, which is always ultimately going to be in balance. Whenever there is an imbalance, okay, our assumption will be it will return to the balanced condition. Right now we can see that there is a skew. The implied volatility is slightly inclined towards the downward strike prices, okay, towards the downside of the market. Okay, but this thing is an imbalance and this is a volatility skew. That this is inferring that right now the scenario is too much bearish. Okay, right now the market is in a fear mode. Okay, so this is how we need to read the implied we need to study the implied volatility. Okay, so volatility is a very fast topic. Okay, I will be going on making videos on volatility in detail. Okay, and in case if you want to study books on volatility, then I'll always suggest you to study Sheldon Nattenberg. Okay, option volatility and pricing. But this book is going to make you really really wise, and really it's going to help you while taking decisions during taking a trade. Okay, so as of now, let's proceed. So we first had an observation towards this implied volatility versus this expiries and versus this strike prices. Okay, so as of now, I am not describing you what exactly implied volatility is. Just for the sake of purpose, I'm telling you that whenever there is an increase in the implied volatility of an option, okay, there will be a price increase. Okay, there will be a price increase. Say the implied volatility of the entire market is increasing. So even after selling out of the money options, sometimes we face that we are not in a certain amount of profit. We are not in a substantial profit. We are still in losses. We are selling out of the money options of both sides, but still we are in losses. Well, this happens because the volatility of the market increases, the vega of the market increases. I once again repeat that this is my channel. In case you want to learn about delta, gamma, theta, vega, and all that in details, okay, I am going to make several videos in details on them. So please don't forget to like my channel, subscribe my channel, share my channel for the needy people, and please don't forget to hit this bell icon. Okay. Also, this is my Telegram channel. Okay, you can. So also this is my Telegram channel, the Delta Neutral. So right now this channel is quite new, so I don't have a pretty much subscribers, but you can easily subscribe. I always continue a Delta Neutral position here with a small account, and I always update these positions. Okay, whenever there is a need for some adjustment, so you can just join my Telegram channel. It's absolutely free. I am not SEBI registered. This is all for educational purpose, but still I share whatever trade I take here. Okay, I am especially a non-directional trader, so whatever trade I take over here, for aggressive traders or for safe traders, for both the viewpoints, I share my trades. I also share these adjustments. Okay, so the link of this channel is given in the description given below. Okay, so your little like and your little subscription would work as an inspiration for me, my friends. So let's continue. So just now we have studied the implied volatility surface. Okay, now we also know that whenever there is an increase in the IV or increase in the implied volatility, okay, there should be an increase in the option prices, whatever the option may be. It can be a call option or it can be a put option. Okay, so now let's go to the paint window, and now let's do one thing. Okay, so now I'll draw a chart, now I'll draw a graph, and this graph will help you for the rest of your trading career, for the rest of your life, while taking decisions and making derivative position. Okay, while trading options, this little but simple, this pretty small chart will help you for your entire life, for rest of your trading career. Okay, so let me draw two axes first. Okay, so let's suppose this is the x-axis and this represents the price axis. Okay, so let's consider this one to be the price axis. Okay, and let's consider a vertical axis, and Let's imagine that this is the volatility axis. Okay, so we have taken two axes, a price axis and a volatility axis. So just now I have told you that whenever there is an increase in the volatility, whenever there is an increase in the volatility of any option, okay, the price of the option goes up. Now we all know that whenever the price of the underlying, this means the price of the underlying, okay, price of nifty, say this is the price of nifty or underlying contract. Okay, I mean it can be the price of any other stock, any other index, bank nifty or any other thing. Okay, I mean the underlying thing upon which you are trading derivatives. Okay, so let's suppose this is the price of nifty. So as the price of nifty will go upwards, and as the what should we buy, what is the option whose value is going to increase? It's definitely call option. But sometimes it happens that the price of nifty, it's going upwards, but still the increase in the value of call options, it is not at all satisfactory, and people will tell you, but because this is due to theta decay, each and every day there is a premium value for the options, and that premium value decreases since options are expiring contracts. Okay, they are not unlimited contracts like equities, they are expiring contracts, so due to theta decay they are diminishing. But not only that, it also diminishes due to a decrease, due to a drop in vega or due to a drop in volatility. Okay, so in case if we observe that there's a chance of the volatility will be going upwards and the price will be going upwards, what is the option we need to buy or sell? We need to buy, we don't need to sell. What we need to buy? We need to buy a call, right? Agree? So whenever there is an increase in the volatility as well as the price of the underlying, what will we do? We will buy a call. Okay, we will long a call. Okay, so we will buy a call. Just the similar, just the opposite. The price is going down as well as the volatility is also going down. So a decrease in volatility, it will, doesn't matter whether call or put option, it will decrease the value of either options. Okay, so there will be a decrease in the value of call options. At the same time, if the market is going down, which would, what is the option whose value is going to diminish? Obviously call option. So just the reverse, whenever the underlying price is decreasing as well as the volatility is decreasing, what you need to do? Simply you need to do the opposite. Simply you need to sell a call. Okay, you simply need to sell a call. See, you can claim that volatility, whenever there is a decrease in the volatility, all option prices will decrease. So I can also short a put option, I can also sell a put option. But where is the conflict? If you short a put option, if the price of the nifty is going downwards, then the value of the put option is going to increase. So the decrease due to volatility will be neutralized or surpassed by the increase in the price because nifty is going down. So that is not a right concept. Okay, so what is the right concept? We have to take the product of both of them. We have to decide based upon both of these parameters, the price and the volatility. Okay, what we generally do is we either go for volatility or we either go for price or we either go for Greeks like delta and all that. Okay, but that is not the right way to take decisions. Okay, you just need to have a look at the simple chart. Similarly, let's assume that the volatility is increasing, volatility in market is increasing, the fear is increasing, there is a more fear that the market is going to move heavily. Okay, on which side? Let's say on the downside. Okay, so there is a volatility, the increase in the volatility, there is a fear in the market, as well as there is a drop in the price. So the market is in a fear mode, the market is falling, some people are telling that okay, it's going to be a stock market crash and all that. At that point of time, what happens is we need to buy a put, because we are buying an option. Why? Because the increase in volatility will increase the value of any options. At the same time, we are buying a put option simply because the market is coming downwards. Okay, so this is the simple approach. Okay, so what we need to do in this case, we need to buy put. Okay, similarly, just the reverse. Okay, similarly, just the reverse. What we need to do here? Okay, whenever the price of the nifty is increasing as well as the volatility is also decreasing. Okay, volatility is decreasing, which means the fear that was there in the market, it's gradually now saturating. Okay, enough is enough. The market retraced too much. The market has fallen 1,000 points, 2,000 points. Now no more to fall for the market right now. The market is definitely going to go up. Okay, so there is a decrease in the volatility, there is a decrease in the fear of the market. Okay, as well as there is an increase in the price. Since there is an increase in the price, we need to sell a put first. Also, we are assuring ourselves that we are selling an option and the volatility must be diminishing now. And also we can see that the volatility is diminishing now. So whenever the volatility is diminishing and the price is increasing, at that time, what we need to do, we need to sell a put. Okay, we need to sell a put. Okay, so from here, okay, so from here, one thing is very visible. Okay, let's say let's say your assumption was that the price of Nifty is going to go upwards. Okay, your assumption was that the price of the Nifty would go upwards. Therefore, you bought a call. Okay, you bought a call. You stayed on this side of this explanation. Okay, you stayed on this side, this green marked side of this explanation. Okay, you bought a call with a view that the market is going to go upwards. The market is moving upwards, but not with a heavy momentum, not with a spiky large movement, not with big candles. It's going upwards but slowly and steadily. So there is a gradual drop in the volatility of the market. Okay, at that point of time, what you do to what you need to do to I mean to maximize your profits or to minimize your losses, you need to sell a put. Okay, you need to neutralize this side. You need to take the appropriate decision that could have been taken if the market was in this side, in the positive price axis. Okay, in case if it was the negative price axis. Okay, okay, let's say you bought a put with a viewpoint that the market is going to fall from here. Well, the market is going downwards, but it is taking a support every time. Buying on dips is happening over there. It's not going down steadily, it's not going down with a proper momentum. But still you are on the left side and you are on the correct side, but still you are facing losses, or still you are not getting satisfactory profits by buying puts. Then what you need to do, you need to sell a call at the same time. Okay, got my point? Now say your viewpoint was that the volatility is going to increase. Okay, and therefore, and you also you had a little prediction that the market is going to go upwards, so you bought a call. But the market is as per volatility, the market is going for you, the volatility is increasing, you are on the correct side on the y-axis, but your direction prediction is wrong. Okay, market is going towards the downside. What can you do to neutralize your trade? You can buy a put after buying this call, and right now this call will be in loss, but this put will neutralize your losses, because one of your viewpoints is correct, because the as per volatility your viewpoint is correct. Similarly, if your volatility if is that the market if your viewpoint is that the volatility in the market is going to go downwards, okay, it's going to go downwards, then you had also made a little prediction. Okay, that you just need to sell a call as the market is going to go downwards. Okay, I'm sorry, you just need to sell a put. Okay, or I mean sorry, you need to buy a put. Okay, you need to buy a put. This I am sorry, I'm very sorry. So this one I need to change here. Okay, this one I need to change here. This was buy a put. Okay, sorry, this was sell a put. Okay, so let's say you are on the right side. Okay, you are on the right side, and you have sold a put, but still the market is going this side. Okay, still the market is going this side. Okay, then how will you neutralize your trade? You will neutralize your trade by selling a call, because half of your viewpoint is correct. You are on the correct axis, but directionally you are wrong. So this will be the counter decision that you need to make. So these are the ways we need to decide. Simply have a look at this chart, simply try to understand what I am saying, and simply study these things. Like see, right now I can say that there is a volatility skew in the market. Okay, the volatility is high at the put ends, and it's usually, if this is the IV scale, okay, which gives us an idea of what is a good support and resistance for the IVs. You can see that it's almost at its high, it's almost at its peaks, and volatility is something which always shows the property of a mean reversion, which means whenever it goes too much high, it reverses to the mean, or if it goes too much low, then again it reverses to the mean. So whenever there is a high volatility scenario in the market, okay, for a number of days or weeks, okay, then we need to be with an approach that going forward this is going to saturate, okay, this is going to attenuate. Okay, whenever a signal like this occurs, it slowly attenuates, and it goes to mean. Okay, so mean reversion is one of the inevitable properties of options, of implied volatility in options. So whenever the market has already become highly volatile, at that point of time you have to think that there will be a mean reversion and the volatility is going to decrease. So at that point of time you need to be in this part, okay, in the negative y-axis part, and just the vice versa. So I have tried to keep things as much simple as possible. Once again, it is my humble request, my friends, please subscribe to my channel. I am going to give you really helpful. Okay, I am a believer in contents. Okay, I am not a believer in editing and all that. So I'll try my best to share whatever knowledge I have had in this much of years, in this much of experience, and at the same time I'll try to give you something unique. I'll try to give you something really simple but unique at the same time. Okay, because simplest things are the worthiest things. Okay, because in trading, if you just complicate things, if you just go too much bookish, or if you just go too much nutty, then it's not going to help you practically. Because whenever you will keep things modular, whenever you will keep things simple, it is definitely going to make the things very visible for you. It is definitely going to make your decisions quite visible for you, based upon which, if in case your decision is wrong, you can take a counter decision, because it's derivative trading and there's always a golden opportunity to adjust your trades. Unlike equities, in equities there are also adjustments, but options are far better than equities in terms of adjustments. Well, so thanks, that's all my friends. Please don't forget to share this video for the needy people. Please don't forget to subscribe my channel. Please hit on the bell icon to get notified as soon as I make a video. That's all for today. Thanks for watching. Thank you.